And when you look at, risk calculations are based on expectations of, three times standard deviation or 5 times, how often they're supposed to occur. In actual fact, they occur more often. And the more you base your calculations on a false theory, the more often they occur. So that is at the core of the current situation. It's a very important element in the current situation, because many newly introduced financial instruments have been built on the basis of this false conception. So these are the alphabet soup, of CDOs, CSOs, CLOs, and so on. And they had AAA rating a few months ago, and they are now practically worthless. So that is evidence that there's something wrong with them. So this is where the super bubble that I'm talking about. You have the housing bubble, which is a very classic bubble. I have a sort of a model of boom-bust process, which goes through well-defined stages. It basically has two components. There's an element of reality, a trend that actually prevails in the real world. And then there has to be a misconception, a misinterpretation of that trend. And then the interaction, the reflexive interaction between the trend and the misconception leads to a initially self-reinforcing, but eventually self-defeating boom-bust process. So there's a trend, and then there's a misinterpretation of that trend, which reinforces both the trend and the misconception. And then you have testing periods, occasional tests, which, if you pass the test, reinforces both the trend and the misconception. If you don't pass the test, that's the end of the story, and you don't have a bubble. But if occasionally you do pass the test, then you have this, you enter what I call far from equilibrium territory, until the misconception becomes so pronounced that it can't be maintained. You have a moment of truth. You then have a twilight period where people know that there is something wrong, but they still continue to play the game. And eventually the trend reverses, and when you cross over, when the trend is downwards, then it accelerates on the downside. And certainly in the sort of the where credit is involved, the downside is much more rapid and catastrophic than the upside. And that is certainly the way the housing bubble has developed over, basically started in 2001 when interest rates were lowered and kept too low for too long, and credit was extended and increasingly more aggressively, and then you sort of entered this twilight period, and then the crisis came in August of 2007, and then you had the acceleration. But then, when the housing bubble burst, it then exposed all the weaknesses that have been built up on this false conception, this misconception, which I call market fundamentalism, that goes back much further. So there is the super bubble, and the super bubble has two components: a basis in reality, which is a credit expansion. That's the trend, and the misconception that markets are self-correcting, and therefore you can leave it to the markets to correct themselves. There have been, whenever credit has been extended, ever since you have had financial markets and credit, you have had periodic crises. And each time you had a crisis, you then had a heart-searching and what went wrong, and some change in regulations that would prevent a recurrence of that. And that's how central banking and the regulation of financial markets has developed really over the centuries. But in 1980, when Reagan became president in the United States and Margaret Thatcher Prime Minister in the United Kingdom, this market fundamentalism that became the dominant ideology. And since then, basically that market fundamentalism was the basis on which financial markets became globalized, which was a really very successful market fundamentalist project, because if financial capital is free to move around, it's very difficult to tax it or to regulate it. So it's very favorable to financial capital. So this was globalization and liberalization, deregulation, removal of regulations. And if you want to look at what has happened, you have to go back a little bit further because